Welcome to the economics class part 1. In this class, we will be looking through some of the important terms which has been asked in the exam. So, beginning with, we have national income. What is a national income? So, the total monetary value. So, the monetary value is nothing but the money of all final goods and service produced by a normal resident of a country in a fiscal year. So this is nothing but we as a citizen, what we do in a daily basis, we transact money, we do business, we earn money, we spend money. So all those money as calculated as the national income of a country. So the national income is equal to the net national at factor cost product. So let us identify or let us see what is a factor cost now. So factor cost is nothing but the total expenses. So it might be, as I said, what we do on a daily basis. It might be the wages we get, the rent, the interest we pay to the bank or the other showrooms, etc., the profits we earn. So all these are called as the factor cost. But one thing to remember here, the factor cost does not involve indirect tax, only direct tax is included. So the formula as follows, factor cost is equal to market price minus indirect tax plus subsidies. So what is subsidies? So these are the money or the fund given by the government for the welfare of the society, right? We all know that. Now what is market price? As I said, we as a citizen, what we do on the daily basis, the transaction of money, the amount we pay for a product, there will be written as MRP, right? So that is the market price of the product. Now, very important, the GDP, the gross domestic product. Now what is GDP? The total monetary value, as I said, the total money of all final goods and service produced within the geographical boundary of a country in a year. So this line is very important. So GDP is considered within the geographical boundary. If, for example, if this is India, if I'm working here, so I have a factory here, so I'm generating employment and I'm earning. So the revenue is considered within the India. And also, if this is Dubai and a foreigner comes and invests in India, and what he earns is considered as GDP of India, not GDP of Dubai. So here it includes both citizens and foreigners. Now what does it not include? It does not include income earned by citizens from abroad, right? So if the citizen of India he is working in Dubai, so his income earned in Dubai is not considered as GDP of India, right? So what is actual meaning of GDP here? So gross stands for the amount which we consider before subtracting. So domestic is within the country and product is, as you know, the final product we get. Now there is another term that is called the GNP. Now what is GNP? It stands for gross national product. So the gross national product is the total monetary value of goods and service produced by the normal residents of a country in a year. So here one thing that differentiates GDP and GNP is, here in GNP geographical boundaries are not considered, but in GDP we consider a geographical boundary, right? So here we consider income earned by foreigner within the country is excluded here. As I said, if this is India, here income earned by the foreigner within the country, if this is a foreigner and is earning in India, so that is excluded. That is not considered as GNP, gross national product. But if an Indian citizen, so this is Dubai, if Indian citizen is working here and he is earning in Dubai, so his income is considered as GNP of India. So what is the formula here? GNP is equal to GDP plus net factor income from abroad, also stands for NFIA. Now let us understand what is net factor income from abroad. So the net factor income from abroad is nothing but the difference between income earned by the country's resident from abroad and income earned by foreigner within the country. So it is nothing but, as I told you, if this is India, if a citizen in Dubai, if an Indian citizen working in Dubai, his income plus the foreigner from other country who is working in India, his income. So the both difference is called as the net factor income from abroad. So how do we calculate? The net factor income is equal to factor income from abroad minus factor income paid to abroad. So here the foreigner is working in India. His income has been paid to his own country. That is, imagine that is Dubai. But the citizen of India working in Dubai, his income is considered as income from abroad. So their difference is called as net factor income from abroad. For example, if Indian in New Zealand, if Indian in New Zealand earns 60 crore rupees and foreigner earns rupees 30 crore rupees in India, so their difference will be 60 minus 30, 30 crore rupees. So this is called the net factor income from abroad. Now what is net national product? The total market value of final goods and service produced by the residents of a country in a given year after deducting depreciation. For this we have to understand depreciation. Before that, remember this formula, NNP is equal to GNP minus depreciation. GNP I told you. Now what is depreciation? So it is a reduction in value of capital goods. So capital goods such as machines, machinery, vehicles, buildings. So due to the wear and tear of these and overusage, then outdated products. So loss in value of assets. So if I if I own a car, imagine if I own a car here. So I bought this 5 years ago. So after 5 years, the value of this car decreases. So it depletes, right? Because of usage. I have been using this car since 5 years. So if I want to sell this car after 5 years, I will get less amount than I paid, right? Because I have used this. So if a new owner wants to ride this car, he will lose that essence of new in the car, right? So because already the previous owner has used it. So that is called depreciation. For example, a company buys a machine at 10 lakh. Imagine a company buys a machine at 10 lakh rupees. So the life expectancy of that machine is 10 years. So he has bought he has bought that machine and the life expectancy of that machine is 10 years. So every year he loses 1 lakh rupees, right? So there is a depreciation. So if a company produces goods worth rupees 50 lakh in a year, depreciation will be 1 lakh per year. So every year the money amount will keep on decreasing because he is using the machine as well, right? So its value keeps on decreasing. So the NNP is equal to, so what will be the net national product then? The 50 lakh minus the depreciation, right? So this is what the role of depreciation works in the economy. And also we have the other term, the net domestic product. So the net domestic product here we consider GDP. The net national product there we consider GNP. And I told you what is depreciation. Now there's another concept. What is transfer payments? So the payments made by the government to individuals without exchange of goods and service in return. So these are nothing but which includes pensions, as we know, pensions for retired persons, then scholarship we give for education, then welfare schemes. And one thing here, subsidies are not included in transfer payments. So transfer payments are nothing but if I am a retired person, so government is paying me pension, but in in return I am not doing anything for the government. If government is paying me, I am not working in the society in order to pay for the government through tax, such as through tax and all, right? So here I am simply sitting after retirement, but the government is paying me. That is called as transfer payments, which includes pensions, scholarship, welfares. So here, what are the items included in national income? The agricultural production, rent, wages, profits, exports, net factor income from abroad, as I told you. then brokerage service, subsidies. So subsidies are all the expense of the nation. So these are all included in national income. And which is not included in national income? What is not included in the national income? The transfer payments, as I told you, what is a transfer payment? Then black money, then intermediate goods. Intermediate goods are nothing but the raw materials. Then we have gifts, donation from the other countries, the charities, household activities. So these are not included in national income. Then moving on, we have two types of income, the personal and the personal disposable income. Now, what is the meaning of it? So, in personal income, the total income received by an individual in a country before paying personal tax. Here, the income of a person is included when personal tax has not been included. So here the personal tax has not been deducted. So this money is before deduction of tax. So that is called personal income. So here income earned plus transfer payment received. So here transfer payment is included. Then what is personal disposable income? So the personal disposable income is the amount to spend or save after paying personal tax. Here it is considered after paying the personal tax. So that is called personal disposable income. So the formula is national personal income is equal to national income plus undistributed corporate profits. So this is nothing but the amount, the whole amount before distributing to the workers. Or imagine you are a factory owner and you earn the profit. So that profit is considered when before dividing it among your employees. Then plus transfer payments, and here corporate tax has not been included. So we deduct corporate tax from here. So the personal income is equal to national income plus undistributed corporate profits plus transfer payments minus corporate tax. Whereas personal disposable income is equal, which includes money after paying tax, right? So personal income minus personal tax paid. So simple, right? Then we have what is known as the opportunity cost. So what do you mean by it? So whenever you make a choice, you miss out the next best option. That missed benefit is the opportunity cost. So for example, if I say you have 100 rupees with you and you have two choices. So you have two choices to spend that 100 rupees. Either you watch a movie or eat at a restaurant. But you choose to watch a movie. So what is opportunity cost? You missed the enjoyment. You missed the enjoyment of eating food at the restaurant, right? So that is called as opportunity cost. So if I that is called as opportunity cost. Now moving on, we have per capita income. So per capita income is equal to national income by total population. So per capita income is nothing but the average income earned by each person in a country. So I am a citizen of a country, you people are citizen of a country. What you earn on daily basis, that is called the per capita income. So this helps to understand how rich or poor people are in a country, right? So imagine if the national income of a country is 10 lakh rupees and the population is 100 crore. So when we divide this, we get 10,000. So this 10,000 is the income of each people per year of a country. Now what is undistributed profits? So undistributed profits are the retained money, the retained earnings. So as I told you, if you are a owner fact, so if you are owner of a factory and you earn profits, that profit before distributing that profit with your employees. So that amount which you keep it with yourself without distributing with your employees, that is called as undistributed profits. That has not been given to stakeholders. That is called as a retained money. See, undistributed profit is equal to net profit minus dividends paid. So you subtract the amount, you subtract this dividend paid. Dividend paid means the profit you got before sharing it with your employees. So we subtract it. Now there are types of GDP here. The gross domestic product. The first one is the real GDP. Now what is real GDP? the total value of goods and service after removing effect of price change. So here the real GDP is nothing but tells us whether a country is truly producing more or not. Just Are they just charging more on the things or the products? So let us understand through example. It will be easy. So imagine year one. So we considered year one as a base year and also consider as year two. Let us differentiate now. So in year one, imagine you are a businessman and you produce 100 pens. So you produce 100 pens and the cost of each pen is rupees 10. So what will be the real GDP? You multiply that amount of each pen with your 100 pens, right? So you get 1000 rupees as a profit. So this is your real GDP. And next year the price of the pen has been increased, but the production of pen is still the same. You are selling 100 pens itself, but the price has not been increased. Price has been increased, production has not been increased. So what is the nominal GDP? So we do 100 into 15, right? So we get 1500. So what could you conclude here? You have just increased the price, but production has not been increased. So there is a loss, right? Your production is still the same, price has been increased. There is no economic growth, right? So this is called the real GDP, where we consider year one as a base year. So we have the second one is the nominal GDP. So this is the total value of goods and service measured at a current market price. Current market price. So let us understand again through an example. So you are a businessman and you produced 100 shirts and cost of each shirt is 200 rupees. So what is the nominal GDP? 100 into 200, 20,000. So this is of year one, and next year you are still producing 100 shirts only, but the cost of each shirt has increased 50 rupees. So the cost of each shirt is 250 rupees for the next year. So the nominal GDP is 25,000, right? So there is a increase in 5,000 rupees. So what does nominal GDP says? So there is an increase in 5,000 rupees, but the real production is still the same. There is no increase in production. Still there is a say production of shirts, right? So economy has gone down. There is no economic growth at all. The third one is the potential GDP. Now what is potential GDP? So here we consider what the economy can produce if everything runs perfectly. So this is just an idea. So for example, so if you imagine the 300 lakh rupees, 300 lakh crores is the potential GDP of a country of India. But due to some unemployment reason or other fact which is decline the economics of a country, since since that is the reason India is producing just rupees 230 lakhs 230 lakh crores. So we consider real GDP 230, but our 300 lakh was an idea. We could have reached there, but so we call it as potential GDP. The next concept is the gross fixed capital formation, GFCF. So what is this gross fixed capital formation? The money spent on building or buying long-term assets such as building, roads, machine, equipments. So this is basically for the future production. Like if you if you think that if I invest on buildings, it will help me further. Like if you feel that your investment will help you in future, so that is called as gross fixed capital formation. So higher the GFCF, more growth potential. So you think and invest. If you feel that in future there is a profit in this, you invest there. So that is called as gross fixed capital formation. Now there is a question: why real GDP is better than nominal? Why? The first reason is the real GDP shows true reason increase in the production, right? As I told you. But in nominal, there is just increase in price, but there is no increase in production. So there is a loss of economic growth. And also real GDP helps compare economic performance as well of the year one and year two, as I told you. And it tells you whether you are actually producing more or just there is an increase in price, right? So for this, India India is deciding to change the base year. Before it was 2011 to 12. So now it has not been changed, but it is in process that they are deciding to keep the base year as 2022 and 23. So government has took the initiative of a 26-member advisory committee on the national account statistics. So the chairman of this committee is the Biswant Goldar. So we also call it as the Goldar committee. So this is current affairs related. So make a note of it. Then what is a GDP deflator? So GDP deflator is nothing but it compares nominal GDP with real GDP. As I told you, what is the meaning of nominal and real GDP? So the formula is GDP deflator is equal to nominal by real into 100. So imagine the nominal GDP is 120 crores and the real GDP is 100 crores. So you substitute this value in formula and you get the difference. So the price level has increased to 20%, right? So compare it with base year. So there is a 20% increase in price level compared to base year. So actually this GDP deflator is published quarterly basis since 1969. So what is this quarterly basis? Like it is divided into 4 quarters. Quarter 1 where we measure from April to June. Quarter 2 July to September. Like that we decided to keep it as for 4 quarterly basis. So now we have another concept of inflationary gap and recessionary gap. So what is inflationary gap? When the actual output, that is real GDP, is more than the potential output. I told you what is potential output. It's just an idea. So in the inflationary gap, here demand increases and supply decreases. So imagine in a society, if a demand increases and there is a less supply. If you go to a grocery stores and the groceries are very less, but demand is more. So the shopkeeper will increase the price of the groceries, right? So this will lead to inflation. Now what is recessionary gap? When the real GDP is, sorry, so in recessionary gap, when the real GDP is less than the potential output, that is, here the economy is underperforming. So what happens here? When real GDP is less than potential output, so so here people spend too little, right? There is low demand. When demand is low, supply is more. So whatever the groceries are left in the shop, it is of no use. So it is a waste of groceries, right? So again here there is an increase in unemployment. Imagine you own a company of IT company. Their supply is more, but demand for that technology is less. So there is a loss there. So you recruit very less people. So unemployment increases. Now what is recessionary gap? So recessionary gap is done. Okay. Now what is recessionary phase? So this is nothing but the economy shrinks, slows down. Like here, people spend less. So when people spend less, shopkeeper owns less, right? Imagine you're a shopkeeper. If people start spending very less, you earn less profit. Therefore, again unemployment increases. There is a job reduction. So this you could see during COVID-19. Whereas the expansionary phase is reverse of it. Here there is economic growth. After COVID-19, when you could see all the economy economies grew again, right? So that's all for today. I'll be teaching the next topic in part 2. Till then, stay tuned and don't forget to subscribe and please share with your friends as much as possible. Thank you.